Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore in India. And in this particular video, we will pick up another interesting topic which deals with the applicability of insurance contract accounting covered under IFRS 17 or from an Indian context, the upcoming Ind AS 117. Whether these contracts do apply to issued financial guarantee contract. There were a lot of requests from the followers who follow my YouTube channel. They have asked for this particular topic to be covered and hence this particular video. So this will be a two-part series. In this video, we will only look at whether and in what circumstances these issued financial guarantee contract fall within the scope of IFRS 17 or Ind AS 117. In the next part of the video, we will also explain this concept with the help of a case study and an illustrative example, and also compare how the accounting under Ind AS 117 or IFRS 17 compares with if the same contract would have been accounted for under financial instruments standard under IFRS 9 or Ind AS 109. So this is the context of the series of videos which we will be creating for this particular topic. So first thing first, to get an answer to this question, whether financial guarantee contracts which have been issued by an entity, are they insurance contracts? To get to this answer, we have to first look at the definitions of insurance contract as contemplated under IFRS 17 or Ind AS 117, and how that information, definition compares with the definition of financial guarantee as we have seen also in one of the previous video as arranged under Ind AS 109 or IFRS 9. Let us see, and that will set the platform to understand this particular question, whether these guarantees fall within the definition of and within the scope of insurance contracts. So if you look at the right hand side of the slide, Appendix A to IFRS 17, or for that matter Ind AS 117, it provides a definition of what an insurance contract is. So if you look at, I have just dissected the definition given in Appendix A to IFRS 17 or Ind AS 117, and this definition says that an insurance contract is a contract under which one of the parties, which is the issuer of the account of the insurance contract, has accepted significant insurance risk from another party to the contract, which will be the policyholder. And in that contract, the insurer or one of those parties or the issuer of the contract has agreed to compensate the counterparty, the policyholder, if a specified uncertain future event adversely impacts the interest of the policyholder. So if you look at the graph below, this simplistically explains what an insurance contract is as contemplated under IFRS 17 or Ind AS 117. So essentially, this is a contract between the two parties, the issuer of the contract and the policyholder, wherein the significant insurance risk get transferred from the policyholder to the issuer of the policy, wherein if this policyholder sustains any losses, say because of flooding of the house, which damages the house of the policyholder, or a hurricane which hits the house and the house gets damaged. So if that risk is, that loss is sustained because of this insured event by the policyholder, then in that circumstances, the issuer of the policy is going to compensate the policyholder on occurrence of such insured event, which is, in our example, is, let's say, damage to the house because of flooding or hurricane. Now, it is important to understand that the compensation need not always be in cash. It can be in kind as well. So the compensation could be in cash, or in the example, if we continue, it could be that if the house has been damaged, the compensation could be in terms of repair work, the cost related to the repair work, or getting the repair work itself done for these houses. This is the way insurance contract has been defined under IFRS 17 and Ind AS 117. Now, if you compare and contrast this, we have already seen in one of the earlier videos the definition of financial guarantee as given in IFRS 9 or Ind AS 109, wherein it says that the financial guarantee contract is a contract which requires the issuer of the financial guarantee to make specified payments to reimburse the holder of the financial guarantee for what? For a loss which the holder incurs because a specified debtor fails to make payment when due in accordance with the terms of a debt instrument. We have seen that. So just to recap our memory, assume if you see at the bottom, it says, let's say Citibank has provided some loan to an entity called ABSPL. Loan is provided, which is supposed to be made. Repayment has to be done by ABSPL, the borrower, to the bank. But assume that a holding company of ABSPL, assume Putnam happens to be the holding company of this entity. And if this Putnam issues a guarantee in favor of the bank, wherein it says, I'm issuing the guarantee to the bank if this guy, my subsidiary, if it defaults in making the payment of the loan repayment, or for that matter, even interest also, for which this guy sustains losses, then in that case, the issuer of the guarantee, the Putnam in this case, will compensate the losses which are sustained by the bank because of the default done by the ABSPL who is borrowed the money from the bank. In this case, if you look at this definition, you will be able to realize that in this fact pattern, ABSPL, who is the actual borrower, whose default causes the loss to the bank, that borrower is the specified debtor in this particular definition. Putnam, who has issued the guarantee, is the issuer of the financial guarantee contract, and the bank is the holder of the financial guarantee contract. Now, if you compare these two definitions, you will be easily able to say that the issued financial guarantee contracts, they very much resemble an insurance contract. And therefore, financial guarantee contract also, just like the insurance contract which transfers significant risks, same way, these financial guarantee contracts also transfer significant insurance risk. And therefore, these contracts also can typically meet the definition of insurance contract as given in IFRS 17 or Ind AS 117. And therefore, because these financial guarantee contracts also transfer significant insurance risk, they can very well be same way considered as the insurance contract. However, with the replacement of IFRS 4 by the new standard IFRS 17, and in the Indian context, Ind AS 104 will eventually get replaced by the newly issued standard Ind AS 117. So with the replacement of these standards, the accounting for these financial guarantee contracts, they may change significantly. Why? That is something I'll explain in the next slide. Because the companies now may need to apply either IFRS 17, which is this standard, or IFRS 9, which is the financial instrument standard, based on certain conditions. That is something I'll explain in the next slide. But this particular slide tells you that given the two types of the definition of the two contracts, it is very much likely that the financial guarantee contract is considered as the insurance contract as well, because of the nature of the risks which get transferred in case of these issued financial guarantee contracts. So moving forward, how would we determine, how an entity or a person determine if the insurance contract accounting covered under IFRS 17 or Ind AS 117, whether that applies to a issued financial guarantee contract? This is something which we will now look at in this video. So if you see this particular slide, under IFRS 17, as we saw in the previous slide, significant changes to accounting may arise. For whom? For entities which have already issued financial guarantee contract in the past and have previously accounted for such guarantee issued under the erstwhile standard IFRS 4 or Ind AS 104. Why so? Because, as I mentioned, unlike IFRS 4 or Ind AS 104, the new standard IFRS 17 or Ind AS 117, in these standard, there is no option for grandfathering of accounting policies. And therefore, on transition, when an entity is moving from IFRS 4 to IFRS 17 or Ind AS 104 to 117, at the time of transition, an entity may need to reassess how to account for these contracts which have already been issued. Right? So, for getting answer to that, on transition IFRS or to IFRS 17, an entity can apply the insurance contract accounting which is covered under IFRS 17 if and only if two of the conditions, which we will see on the right hand side, only if certain conditions are met. Thereby meaning that the financial guarantee contract already issued by an entity which is now transitioning to IFRS 17 or Ind AS 117 will apply or may apply IFRS 17, the insurance accounting standard, or Ind AS 117 only and only if certain conditions are met. What are those conditions? Let us see on the right hand side. There are two such conditions which needs to be satisfied. So an entity can apply, it's not a mandate. An entity can apply IFRS 17 or Ind AS 117 to issued financial guarantee contract if and only if two of the conditions are satisfied. What are those? These are the conditions. So the first condition is that the entity which has issued the financial guarantee contract in the past has, previously, they have very, very specifically asserted that they regard such financial guarantee contract which they have issued not under financial instrument but as insurance contracts. This specific assertion has been made, and accordingly they have accounted for those contracts under insurance contract and not under financial instruments. By the way, these are cumulative and conditions. If both of these conditions are satisfied, there is an option which is available to the entity on transition to apply IFRS 17 or Ind AS 117 as the case may be. This is what I just said, the option. Also, even if the entity meets both of these conditions, it can still irrevocably elect to apply either IFRS 17 or IFRS 9. That thereby meaning, even if these two conditions are satisfied, it is not mandated by the standard that you still got to apply IFRS 17. No. So you have, as an accounting policy choice, an entity may still apply either IFRS 17 or IFRS 9, thereby meaning from the Indian context, Ind AS 117 or Ind AS 109 as an accounting policy choice. That choice is still there. The only thing which is important is that this choice is available on an irrevocable basis, on a contract by contract basis. What does it mean? Contract by contract basis. So for example, if an entity would have issued in the past before transition 3 such financial guarantee contract 1, 2, and 3. They may say, I will apply to this financial guarantee contract number 1, I will apply IFRS 17, but for the other 2, I will apply Ind AS 109 or IFRS 9. This is permitted because this option, this accounting policy choice is on a contract by contract basis. But the moment you make this choice, that choice becomes irrevocable for the life of that particular contract. We will conclude it in the next slide. All what we have discussed to summarize whether IFRS 17 or Ind AS 117 actually applies to issued financial guarantee contract. I have brought forward this the chart which we already saw, that here, as I said, basically there is a choice which the entity has, that on transition it may apply IFRS 9 financial instrument standard or insurance contract accounting standard, perhaps 7E of IFRS 17, as well as under Ind AS 117 makes specific assertions about that. It says, although financial guarantee contracts like the ones which we saw in the example, they meet the definition of insurance contract under IFRS 17, but these contracts are outside the scope of IFRS 17 unless the issuer, in my example, this guy, Patnam, the issuer has previously asserted that it regards such contracts as insurance contracts and have accounted for them as insurance contracts. But as I said, this can be applied only if both these conditions are met, and that also is a choice. Paragraph 7E of IFRS 17 or 117, it also further explains that even if both these conditions are satisfied, the issuer of the financial guarantee has an irrevocable accounting policy choice on a contract by contract basis to apply either IFRS 17 or the financial instrument standard, the suite of standards covered within these 3 standards, IFRS 9, your IAS 32, and IFRS 17. Correspondingly, you have 3 standards under Ind AS 109, Ind AS 32, and Ind AS 107. Right? Anything which is not covered here, okay, if in all other circumstances, the standard clarify that the issuer will account for such financial guarantee contracts which it has issued in accordance with financial instruments standard only and not under IFRS 17 or 117. So this is exactly what I wanted to cover in terms of the whether they are in the scope of the standard 117 or IFRS 17 or not. We will continue our deliberation on this particular topic in the next video, wherein we will talk about a specific case study, an illustrative example to explain how the accounting happens if those financial guarantee contracts are actually accounted for under the insurance contract accounting, okay, which is under IFRS 17 or 117. I will explain that with the help of a case study, and it will also compare how, if you compare the P&L and the balance sheet impact in 2 circumstances when it is considered and accounted under financial instrument standard versus the insurance contract accounting standard, how the pattern of the recognition of income or how the liability arising out of these contracts may differ. Okay, that is something which we will see. For this video, we will take a pause here, and I have given my social media contact along with the QR code. Feel free to connect with me on these social media contacts, and I'll see you in the next video very soon. Thank you. Bye for now. Take care.